I'm Glenn Campbell. I call myself a demographic philosopher. I'm looking at life and trying to predict the future through the lens of demography, or the study of human populations. Today I'm going to talk about the time bomb of U.S. government debt and the terrible things that will happen as it becomes less and less sustainable. This isn't a new topic to this podcast. I've talked about it before the virus, but it was mostly academic back then. Federal debt has been unsustainable since at least 2009, and something bad was destined to happen, but it was hard to pin down exactly when. As of late 2019, unpayable federal debt has been building up for a decade, and for all I knew, it could have continued to build up for years before there was a reckoning. Now, thanks to the virus, the day of reckoning is close at hand, and I predict by the end of this year, 2020, we will see major cracks in both the viability of U.S. debt and the value of the U.S. dollar. So in today's podcast, I'm going to revisit federal debt in the light of a crisis happening this year as opposed to some vague time in the future. The bottom line is this: I expect significant inflation by the end of 2020, spiced with a healthy dose of deflation. The price of all the things you need is going to rise, while the price of all the things you don't need is going to drop. Does that make sense? What I mean is, if you want to buy a luxury car, this is a great time to do it because no one wants to buy. But if you go grocery shopping, you're going to see your prices rise before the end of 2020. Meanwhile, the U.S. government will become more and more dysfunctional as its financial underpinnings erode. The next presidential administration, be it the Trump or Biden administration, could end up being America's last. I know this sounds outrageous, but that's why I need a whole podcast to explain it to you. Today is April 9th, 2020, and the world is still in the midst of a lockdown mania in response to the COVID-19 epidemic. However, the biggest event on the planet right now is not the epidemic. The truly epic, world-changing event, the biggest since World War II, is the collapse of the world economy. The virus didn't cause the collapse, it was merely the trigger. It turned out to be a really efficient trigger, but even if coronavirus had never happened, the world economy had built up so much dynamite that something would have set it off. The dynamite took the form of massive worldwide debt and absurdly elevated asset prices, powered by the desperate policies of central banks in response to the global financial crisis in 2008. Yes, central banks and big government saved the world economy in 2008, but only at the cost of kicking the can down the road toward even a bigger crisis in 2020. In a wider view, there is also a demographic source of dynamite, a sort of supercycle stretching back some 70 years. Following World War II, there was a baby boom, and those babies grew up to fuel a huge economic boom in the late 20th century. In the 21st century, that fuel started getting depleted. The baby boomers began retiring in 2011, moving from being assets to society to liabilities. No matter how you slice it, we can't reproduce the breakneck growth of the late 20th century because we don't have enough workers to power it. But the whole financial system is still geared to the assumption that past growth will continue. The rise and fall of the baby boomers is sufficient in itself to cause a financial collapse, but there are many other kinds of financial dysfunction afoot. I can't hope to cover them all in this episode, so I'm going to focus on one key area: U.S. government debt. Part of the U.S. debt crisis is demographic, those baby boomers, and part of it is due to years of political stupidity because there's really no penalty to politicians in borrowing from the future. Before the virus arrived, the world economy was already an interlocking series of Ponzi schemes, paying off present investors at the expense of future ones. Ponzi schemes can go on for years in apparent stability, as did Bernie Madoff's famous plan, but when they collapse, they do it catastrophically. And one Ponzi scheme tends to pull down all the others. And that's exactly what's happening today. 2020 is the year that all the Ponzi schemes collapse. But in this episode, I'm going to only talk about one of them, federal debt and monetary policy. Because of all these harebrained schemes, federal debt is probably the easiest one to understand. For at least a decade, the U.S. government has been issuing bonds they cannot possibly pay back in the long run. The only difference here is that this Ponzi scheme is entirely in the open. Investors ought to be able to see what's happening, but most of them are blind. I got into demography because it is the only social science that can make hard and reliable predictions. For example, there's one fundamental unbreakable law of demography. You can't have more people in the future than are born today. In other words, if your country makes 1 million babies this year, then you can have no more than 1 million native-born citizens 20, 40, and 60 years from now. There can be less than 1 million in each age group because people die, but there can never be more. This fact may sound obvious, but it's a very powerful tool when predicting what the world will look like 20 or 40 years in the future. Likewise, in economics, there's one fundamental, unbreakable law. In the long run, you can't spend more money than you make. You can't do it as a private citizen, and you can't do it as a government. There is no free lunch. You can borrow money from banks, credit card companies, family and friends to support a more extravagant lifestyle than you can afford, but you can't do that forever because sooner or later, people are going to stop loaning you money. If you're a consumer, there's usually a hard limit when credit is cut off. On a certain date, your credit card gets maxed out and no bank will give you a new one. You can default on your credit cards by simply not paying them, but now you have no choice but to live within your means. At best, you'll have to go back to living hand to mouth. At worst, you'll have all your creditors knocking on your door trying to confiscate everything you own. With a government, the limits are much more elastic. There's no hard date when credit is cut off because the government or its surrogates control the money supply. In a pinch, they can print new money to pay off their debts, which is essentially how the U.S. government is funding itself now. The only downside to money printing is inflation, or the devaluing of the currency. Consumer inflation has been more or less absent from the U.S. economy for some 30 years, but it will be back because you can't flaunt the laws of nature forever. You simply can't spend more money than you make. If you don't believe this axiom already, there's probably nothing I can say to change your mind. There are all sorts of economic sleight of hand theories, like modern monetary theory, that allows otherwise intelligent people to believe it isn't true, that you can spend more money than you make. I'm not going to go down the rabbit hole of arguing with these theories because there's no way I can win. It's like arguing with someone about their religion. No logical argument will work. You can't spend more money than you make. Either you believe this or you need to stop listening because nothing I say is going to make sense to you. If you do spend more money than you make and you do it consistently over time, there will eventually be a day of reckoning, a day when the credit cards max out. You may be able to extend the date by borrowing still more money, but it only makes the reckoning more brutal. For almost 20 years, the U.S. government has failed to balance its budget, consistently spending more money than it makes. It does this by issuing bonds to the public, promising to pay in the future, which is just like spending on your credit card, except the interest rate is much lower. Government spending greatly accelerated during the global financial crisis in 2008. The deficit was gradually brought down over the course of the Obama administration, but it exploded again under Trump. In 2019, before the virus, the math was pretty simple. The government spent about $4 trillion a year and took in only $3 trillion a year in taxes. You don't have to know what a trillion is to understand the math. 25% of the money the government spent in 2019 was added to its credit card bill. Before the virus, the total outstanding debt was about $22 trillion, or more than 7 times the annual tax income of the government. By some measures, it could have been several times higher, maybe even $100 trillion, when you consider the government's future obligations for things like Medicare and Social Security. The exact trillions don't matter, as much as the qualitative fact that the government always spends more than it makes, with no realistic prospect of ever paying down its outstanding debt. And that was before the virus, which is an unprecedented economic disaster, the likes of which the world has never seen. People are losing their jobs in vast numbers, which ultimately means less tax revenue for the government in 2020. Meanwhile, virtually every national response to the virus involves massive government spending, well beyond the previous $4 trillion. It's unclear yet what the damage will be, but it's reasonable to guess that tax revenues will fall to something like $2 trillion, while the total government budget rises to $5 trillion or higher. In other words, the government will be borrowing more than half the money it spends in 2020 and perhaps into the following years as well. The government is closing the shortfall by issuing bonds, which investors around the world are expected to buy. So how are investors responding to this glut of bonds? You would think they'd be running for the hills, but no, they're running directly into the fire. As of today, the investors are eagerly buying all the bonds the government can issue, and they're paying a premium to do so. It's the craziest thing. You've got an insolvent debtor, obviously living off his credit cards with no hope of ever paying them down, and investors are lining up to loan him even more money. Max out one credit card? No problem. Here's another one at a low introductory interest rate. The eagerness of investors to buy U.S. government debt is reflected in the yield, or the effective interest rate on the bonds. Although the government issues the bonds with a nominal interest rate, the actual interest rate is determined by the open market. And right now, investors are willing to accept an interest rate on 10-year U.S. bonds, or T-notes, of between 0.5% and 1% per year. In other words, if you loan the government $10,000, you'll receive at most $100 in interest for the entire year. Clearly, investors aren't buying the bonds for the income. They are buying them as a perceived safe haven. In periods of market chaos, like we've seen over the past month or two, investors are bailing out of stocks and other investments, and when they do, they have to put their money somewhere, and U.S. government bonds are seen as the safest investment there is. U.S. government debt can never fail, the reasoning goes, because the government controls the printing presses and can always print more money to pay its bills. Yes, but there's a cost to printing money, which is inflation. In other words, you can loan $10,000 to the government for 10 years and feel reasonably confident that the government will pay you back at the end of this period. But the $10,000 the government gives you then may not buy as much as the $10,000 you gave them. And that's inflation. Despite 30 years of apparent stability, $10,000 does not have a fixed value. It is worth only what the parties who exchange it think it is worth at the time of the transaction. In other words, you can walk into a store with $10,000 in your pocket, and maybe you can buy the entire store, or maybe you can buy only a single egg. This has really, truly happened in many a banana republic. If you flood the market with too much of your own currency, the value of each unit of the currency goes down, and the price of products and services in terms of that currency go up. If you were born in the USA in the 1980s or later, you have almost no experience with inflation. You think a dollar is worth a dollar. I, on the other hand, came of age in the 1970s and had a personal relationship with inflation. At the beginning of the 1970s, you could go into a candy store with a dime or two in your pocket and come out with a lot of candy. Back then, they had something called penny candy. There were a whole range of candy items under a glass case, each for a penny. A small Tootsie Roll was a penny, or a Mary Jane Taffy. A stick of licorice was a penny. Candy cigarettes were 3 for a penny, and they tasted good. You would pretend to smoke them just like a grown-up. When you went into the penny candy store, you'd point out the things you wanted, and the lady behind the counter would put them in a little paper bag for you. If you walked in with a quarter, you came out feeling like a millionaire in candy. Standard-sized candy bars, identical to the Snickers and Hershey bars of today, were 5 cents at the beginning of the 1970s, but they didn't stay that way. Over the course of the 70s and early 80s, I saw their price rise to 7 cents, then 10 cents, and 15 cents, and 25 cents. Eventually, the price of a Snickers bar stabilized at something around 60 cents, sometime in the late 1980s. Today, a Snickers bar at the supermarket checkout is about $1, but I consider that more opportunism than inflation. If you go to the back of the store and buy a multi-pack, the 60-cent price still holds. I don't remember when penny candy ceased to exist because I aged out of the market anyway, but I distinctly remember the price of a standard size Snickers going from 5 cents to 60 cents in what seemed like a short period of time. It was almost to the point where you would want to buy an extra Snickers right now, knowing that the price might go up next week. And that's a whole experience that you youngsters have never had. You don't realize that a dollar isn't just a dollar. A dollar is only worth the number of Snickers bars you can buy with it. America has had inflation before, and believe me, it will have inflation again. When will it happen? Well, apparently not right now in April 2020. In this era of national lockdowns, no one is raising their prices for anything, especially when it's hard to get people into the stores to begin with. McDonald's still has its dollar menu for takeout only, and you can still go to a Dollar Tree store and buy things for $1 that are pretty much the same as the things you might have bought there 30 years ago. If anything, we're in a period of deflation now, especially for things you don't really need. No one is in the market for a car right now, and dealers are hurting, so maybe this is a good time to cut a deal. The Great Depression, in fact, was a period of rampant deflation, called a deflationary spiral. The price of an apple kept going down because there were too many apples and too few buyers who could even afford an apple. Luxury cars were being sold on the street for pennies on the dollar by investors who lost everything in the stock market crash. Deflation is a self-fulfilling prophecy because it encourages people to hold on to their cash. Why should you buy a washing machine now when you know it's going to be even cheaper in 6 months? But back in the Great Depression, the government wasn't printing money like there's no tomorrow. Back then, the US dollar was supposed to be based on gold. The system got a little flaky, but essentially the dollar in your pocket represented gold stored at Fort Knox. So the government couldn't just print money at will. Inflation took off only after 1971, when Richard Nixon took the U.S. off the gold standard. The dollar then became a fiat currency, meaning that it's not inherently worth anything. It can't be converted into gold. It can only be sold to another sucker for however many apples or Snickers bars he chooses to give you for it. Going off the gold standard untethered the dollar and set the stage for the massive inflation of the 70s and 80s. So what this means today is that the government, or its surrogate, the Federal Reserve, can print money at will without any restriction. And the current environment makes it mandatory that the Fed prints more money. It simply has no choice. You may think of the Fed as an independent agency, but it isn't. If the government spends more money than it makes, the Fed is obliged to print more money to make up the shortfall. I want to explain how money printing works and how money is created in the American system. It's actually quite simple. So let's start with that basic 2019 calculation. The government spent $4 trillion and took in only $3 trillion in taxes. It's actually $4.5 trillion and $3.5 trillion, but I like round numbers and the exact amounts don't matter. The extra trillion has to come from somewhere, and that's government bonds, notes, and bills. I'll just call them government bonds. Periodically, the government issues bonds and offers them to the market at auction. Investors buy the bonds, effectively loaning money to the government, and then they pass them back and forth between each other in a secondary market. Bonds are seen as highly liquid, meaning you can buy them one day and sell them the next, unlike a fixed asset like real estate, where you may not be able to find a buyer at all. As I said, investors around the world love U.S. bonds right now. In the era of crashing markets, U.S. bonds seem like the prettiest house on an ugly street. If you've got cash, U.S. bonds seem like the safest place to stash it. Of course, there's gold. You can store your wealth in gold, but that's a quagmire I really don't want to get into right now. The point is, investors perceive U.S. bonds to be a safe haven, whether or not they truly are. So you've got this perfect symbiotic relationship. The government needs to borrow money, and investors are eager to loan it money at ridiculously low interest rates. What could possibly go wrong? Well, what could go wrong is that the government eventually issues more debt than the market can bear. As of the end of 2019, the government had 22 trillion in outstanding bonds. At what point has it issued too much? 40 trillion? 60 trillion? I really have no idea. This isn't like the fixed credit limit on your credit card. There's no clear cutoff point, but there will be a point where things start falling apart. And once things disintegrate enough, there's usually a catastrophic failure. U.S. bonds are really no different than any other commodity, like watermelons. If watermelons are relatively rare, each one can command a fairly high price. But if you flood the market with watermelons, then eventually the price falls. If there's a glut of watermelons to the point where every grocer has a ton of them, then the price can truly plummet because they've got to move those watermelons before they rot. For a bond, the price is reflected in the yield, or the interest rate that investors are willing to accept to hold it. If bonds are desirable, as they are today, the yield is low. Right now, they're between 0.5% and 1% per year. When bonds are plentiful and less desirable, the yield goes up. Investors expect to receive more interest in exchange for loaning the government money. The yield also rises in anticipation of inflation. If you expect the $10,000 you give the government to be devalued over the course of the bond, then you're going to demand a higher interest rate to compensate. I visited Ukraine about 5 years ago, and I saw a billboard for a certificate of deposit at an interest rate of something like 40% per year. My jaw dropped at that, and I double-checked the translation app. 40% implies that inflation of the Ukrainian hryvnia, something like 35% inflation. In an economy like that, you definitely don't want to keep your hryvnias in a mattress because they will be devalued by 35% every year. And if you leave your hryvnias there for 10 years, they're hardly worth as much as the stuffing in the mattress. If you've got hryvnias in your pocket, you want to get rid of them as quickly as possible because coins and bills are losing value every single day. Instead, you'll buy one of those CDs, or you'll buy a foreign currency, or you might buy some other commodity like Snickers bars that you know you can resell later and retain your buying power. This little diversion into hryvnias actually has some relevance to my thesis because I want you to imagine what would happen if U.S. inflation went that high. People would want to get rid of their dollars as quickly as possible, which actually accelerates inflation. People wouldn't be keeping anything in their mattresses or their piggy banks. They would be dumping every dollar they earned right back into the market, preferring commodities like Snickers bars or something they can resell. This is called the velocity of money, or the number of times a unit of currency changes hands in a given period. As the velocity of money increases, so does inflation. I'm not just playing with hypotheticals here. I truly believe that sometime in the future, the US dollar will match Ukraine's inflation rate, 35 or 40%. You can call me a fool because it certainly isn't true today. If investors are willing to commit now to loaning the government money for 10 years at an interest rate of 1%, it implies not only that interest rates will remain low for those 10 years, but that inflation will be virtually non-existent during that time. That's a lot to assume, and I think it's crazy. For the past couple of years, the official inflation rate, calculated by the government, has been hovering around 2%. There are all sorts of ways you could argue with that number, but the point is it's not zero, and it's probably higher than the 1% yield on the bond. This means effectively that investors are loaning money to the U.S. government at a negative interest rate. They are getting less out of the deal than the money they put in. This is truly insane, and although markets can sustain their insanity for a while, eventually reality crashes the party. Reality will eventually take the form of investors saying, okay, I already have enough U.S. bonds. I don't want any more. I already have enough watermelons. At that point, the yield rises and the government has trouble selling all the bonds it issues. The market doesn't want them anymore unless they are a true moneymaker. I might still loan $10,000 to the government for 10 years, but I would expect a higher interest rate, like 10%, to compensate for the potential inflation and the potential of a government default. Could the government really default? It wouldn't happen tomorrow, but over the course of 10 years of financial chaos, who knows? In any case, if I were to loan money to a dodgy debtor, I would expect a yield that is high enough to justify the risk. So what happens when the government reaches the point where it has issued so many bonds that the market can't absorb them anymore and yield rises? Is there any recourse? As a matter of fact, there is. There's the Federal Reserve, which is supposedly this independent bank that manages the money supply. If you look at a dollar bill in your wallet, you'll see that it isn't issued by the U.S. government itself. It is issued by the Federal Reserve. It is a Federal Reserve note. The government issues government bonds, but the Fed issues the currency and controls how much of it is in circulation. In theory, it can increase inflation by issuing new currency and decrease inflation by taking currency out of the system. It is the Fed, not the government, that prints the money, although the word printing is a misnomer. The Fed creates money simply by adding digits to the bank accounts of member banks. But printing money is still a pretty good analogy. The Fed can print money whenever it wants for whatever reason it wants because it is nominally independent of the U.S. government. The way money printing works is the Fed buys something from the marketplace. In most cases, it is buying government bonds, but in practice, it could probably buy anything. The Fed could buy Snickers bars or apples or whatever it wanted. I'm sure there are rules against the Fed buying Snickers bars, but there's no one to enforce the rules. When the Fed buys something, usually bonds, it creates new money out of thin air to give to the seller. It is thereby increasing the money supply and risking inflation. So how this whole process works is the government issues bonds to fund its deficit and sells the bonds to the public. Then the Fed buys the bonds from the public and creates new money to give it to the seller. Money supply increases, and eventually so does inflation. So how is this different than the Fed just buying the bonds directly from the government? The truth is, it isn't. For all practical purposes, the Fed is buying the bonds directly from the government. The government is spending money, and the Federal Reserve is printing the money to pay for it. The amount of new money printed is reflected in the Fed's balance sheet, or the assets it technically holds. Right now, the balance sheet is roughly $5 trillion, and it's increasing quickly. This isn't all government bonds, but it's all artificial support. The Fed is printing money hand over fist to prop up both the government and the financial sector. And at this point, there's virtually no hope of the money printing ever stopping. If the government issues too many bonds to the point where investors lose their taste for them and start demanding higher interest, the Fed is essentially obligated to step in and buy those bonds. It has to buy them to reduce the supply and prop up the market for those bonds. It creates new money that in essence the government uses to pay its bills. It's a perfect system. The government spends more than it makes, and the Fed prints the money to fund that spending. It's the perfect system except for inflation. If any government keeps printing money to pay its bills, eventually inflation rears its ugly head. It's true in any Latin American banana republic, and it's true in our banana republic. It's just that in our republic, there's been a delay. The Fed has been printing money with abandon, but there's been little apparent inflation on the ground. So what gives? Where has the inflation gone? The answer is it's hiding. And it's hiding in two places that I am aware of. One hiding place is in plain sight. It's called asset inflation. The price of a Snickers bar may not have changed, but housing prices have gone way up, especially in the desirable places where people most want to live. If you live in San Francisco, you've seen massive inflation in your housing costs. Before the virus, virtually all assets, from stocks to bonds to fine art, were vastly overinflated. All of those assets are now in the process of deflating. The second hiding place is mattresses in Ukraine. If you're a shady businessman in Kiev, dealing only in cash, you're not going to keep hryvnias in your mattress because they'll lose value almost instantly. But you might keep US dollars in your mattress because they are perceived to be stable. For decades, the US $100 bill has been the preferred store of value for drug lords everywhere. The US dollar is also a haven currency for legitimate investors. It's seen as a safe haven, at least compared to other currencies. So what might be happening here is the Fed is printing money, but if investors overseas are stockpiling dollars at about the same rate, then there's no net excess of dollars and no inflation. That's just speculation on my part. I'm not really sure it's Ukrainian mattresses that are soaking up the extra dollars. All I know is that there's a certain market for dollars, just like watermelons. And once the watermelon market has reached saturation, the price is going to take a dive. What the price crash means for the dollar is a debasement of the currency, where the dollar in your pocket doesn't buy what it used to. If you have inflation, you can't buy a $1 cheeseburger at McDonald's anymore. It's going to be a $2 cheeseburger and then a $4 cheeseburger. Once you start to get substantial inflation in the US dollar, then a switch gets flipped and everything changes very quickly. All those folks in Ukraine with dollars in their mattresses suddenly don't want to keep them anymore. They sell their dollars into the market to buy some other store of value like Snickers bars, and suddenly the velocity of dollars increases dramatically. Dollars aren't just sitting in mattresses or dresser drawers anymore. They are immediately returned to the market to buy something else. This in itself causes more inflation, since there are so many dollars seeking too few buyers. That's what's behind the hyperinflation of places like Venezuela and Zimbabwe. Not only is the government printing money to pay its bills, but consumers don't want to hold on to their currency for more than 2 seconds. They immediately use their money to buy some tangible good that will hold its value. I got a sense of this mindset in the 1970s, when there was always pressure to buy something now rather than later, because you didn't know when the prices were going to go up again. People got rid of their dollars, or at least put them into high-yielding bank accounts, because you didn't want to hold on to your cash for too long. It would simply lose value. I predict that all of this will be coming back sooner or later, and I'm placing my bets on sooner. I'm thinking of 1970s style inflation, like 10 to 20% by the end of 2020, and Ukrainian style inflation of 30 to 40% sometime thereafter. Don't hold me to that timetable, because I don't know the saturation point where the world has absorbed all the dollars it can. I can only predict that inflation, once it comes, will not be a gradual process. It will accelerate very quickly, because once you reach a certain threshold, it starts triggering all sorts of feedback loops, like people emptying their mattresses of dollars. So why is the Fed obligated to print dollars? It is supposed to be an independent agency. So why can't it just tell the government, screw it, we're not going to fund your spending anymore? It could do that, but then we'd have a different kind of crisis, a bond crisis, which is just as bad for the economy as inflation. So at some point, the bonds issued by the government are going to run into market saturation, where the supply exceeds the demand and the price drops and the yield rises. Historically, the interest rate on long-term government bonds tended to hover around 5%. But following the global financial crisis, the yield has been artificially low, bottoming out for the 10-year bond at the 1% or 0.5% we see today. This seems to be great for the government, at least on the surface, because it means that for all the debt the government has outstanding, it is paying relatively little total interest every year. This is like getting a new credit card that offers you a low introductory rate of only 0% for 18 months. This is great for as long as the low rate lasts, but it sucks as soon as the introductory period ends and you're paying 18% instead. So an excess of bonds means a rising interest rate, and the government has to spend substantial tax revenue on interest alone. If the government has $22 trillion in debt, which it has to roll over at periodic intervals, and the interest rate rises to the normal level of 5%, the government now has to pay over $1 trillion in annual interest rates alone. And if the tax revenue is only $3 trillion a year, and even down to $2 trillion during 2020, the government is now spending something like half its tax revenue on interest payments alone. Of course, it doesn't have the money, so it will borrow the $1 trillion for interest payments, further adding to the supply of bonds and driving up the yields. This is a vicious feedback loop that eventually ends in the collapse of the government, which the Fed can't allow. Instead, the Fed is going to buy the excess bonds to try to drive down the yield to a manageable interest rate. The money it prints to buy the bonds eventually results in inflation, which isn't good either. So the Fed is between a rock and a hard place. It has no control over how much money the government spends or how many bonds it issues, but it is obliged to print money to fund it. It's a doom loop, no matter how you look at it. So that's about as far as I want to go right now. There are all sorts of questions arising, like what happens when inflation comes back, and what happens when the government can't borrow money anymore at ridiculously low interest rates. My only answer to those questions now is bad things are going to happen. But it's hard to say exactly what will happen and when it will happen. It's like the Titanic is sinking, taking in more water than it can pump out. You know the ship is going down and that there aren't enough lifeboats. But you don't know now who's going to be saved, who's going to die, when the event will happen, or how the ship is going to break apart as it sinks. Once a doom loop has started, it's difficult to predict where it will end.